are you concerned about Tesla's, inauspicious addition to the S&P 500 yesterday, or is that just froth?
We're not concerned because we don't own the stock. So, I mean, it's a stock we follow clearly like everyone else. But as far as our view on the company, I mean, it's clearly a growth company. It's been a growth company since day one. It's been a company that most investors have been skeptical of since day one. And I think that skepticism, that quote unquote wall of worry for this stock has helped propel it higher in the sense that Elon Musk and co has really kind of bested most everyone's expectations on what the EV market can do over the next couple of years. I mean, I think until we get some real bona fide competition in electric vehicles, Tesla has a pretty clear path in that market, and that's what the stock's reflecting.
Well, Jason, you're a tech fund manager. Is it like legal that you do not own Tesla?
Well, to be clear, Brian, we're not just tech. We are overweight tech. We've been overweight tech for a long, long time, for as long as you and I have been talking. But we also go, we have wide moat consumer discretionary. We have some industrials. We have some financials. We have healthcare. So we're a little broader than that. But no, I mean, look, we've missed Tesla. That's something that I admit. We thought about buying it back at 150 a number of years ago, and that seemed a little bit too expensive at the time. And I look back and chuckle at that. But we do own Google and Apple and Microsoft and Visa and a handful of other technology companies that have done well. So we're satisfied with where we are. But nonetheless, Tesla has taken up a lot of oxygen in the room in terms of the tech conversation.
Well, I almost feel like, Jason, everything is technology these days. Even mining companies will tell you that they're tech because of something. So let's switch gears and get some stocking stuffer picks for our viewers. Robotic surgery, Intuitive Surgical, ISRG.
Right, that's one we added this year in the sell-off. Intuitive Surgical is dominating the market in terms of the intersection between healthcare and technology, as you noted. Robotic surgery has a very long runway of growth. Intuitive Surgical is by far and away the dominant player there. There's a couple of others. Medtronic, Johnson & Johnson has a toe in that market, but the opportunity to continue to use robotic surgery and technology and software to improve patient outcomes is something that Intuitive Surgical is benefiting from across a number of different procedures, and we think that runway for growth over the next 5 to 10 years looks really impressive. And the stock's not as expensive as it used to be. One of the more expensive on a PE basis in our portfolio, but reasonable given the growth.
Yeah, and another name that I hear a lot about but doesn't get any attention, it's tucked up there, and I think Milwaukee, that's associated with the Milwaukee Bucks arena, is FISERV.
That's right. Yeah, this is a really boring company, and we love boring technology companies. We definitely have exciting ones too, but FISERV just continues to be the plumbing, the software, and fintech plumbing for most of the largest, credit unions and regional banks in the country. I think they have about 15,000 different customers and just continue to grow quietly. This is a company that's grown their earnings per share double digits for 31 straight years. That includes the 2008-2009 great financial crisis. That includes the pandemic this year. They just had a great quarter and up to their guidance. The return on invested capital for this company is through the roof, and they just continue to operate in an industry where no one really is trying to come in and impede on their economic mode, and they really have a wide moat because they are the main core banking software for most of these credit unions, and then they cross-sell all of these other different services that are higher margin. So FISERV continues to be a nice growth company at a reasonable price.
Shepard Smith here. Thanks for watching CNBC on YouTube.